There we go. Welcome, everyone, to the February 26, 2026 live payroll restoration community Q&A. I am Shannon Ballman Theis, the payroll queen, and since this is a live Q&A, I do have some questions prepared, but I want to see if anybody that is attending live has any questions that they want to ask first. Okay, I don't see anybody have any questions right now. So the first thing that we're going to do is we do have a question already prepared. I manually do payroll taxes through QuickBooks. I filed them myself with the appropriate organization. For my W-2, W-3, QuickBooks gave me the option to e-file. I didn't pay anything, which I thought was weird. I went through the process and my filing screen says submitted on January 14th, 2026. I was to get an email confirmation stating the e-file was successful. I never received an email confirmation. When I call QuickBooks, they say that they were filed and are in the queue for the IRS, but I still don't trust that it's done because I have no proof except my screen saying submitted. What would the penalty with the IRS be if they actually did not submit my e-file, therefore they are late? What would be the problem if I filed them through Track 1099? It would probably duplicate the wage and would cause issues. So they didn't say which QuickBooks payroll product they were using, and I do know that this year, so we use QuickBooks Desktop for all of our regular payroll that's processed on time and in through my other company, River Valley Accounting. And we had clients whose we sent in their W-2s around anywhere from January 16th through January 29th. And there it did take a couple of weeks. Like I just cleared our last regular recurring payroll W-2 e-file confirmation a week ago, which is later than we've ever been waiting for the e-file to be successfully submitted to Social Security. The flow for W-2s is they get sent by the payroll software or through a service like Track 1099. They go to Social Security, and then once they're processed with Social Security, they then get sent to the IRS. So we usually can't get confirmation from the IRS that W-2s have been received or submitted until usually June at the earliest most years. So I just want to kind of clear that workflow up. And when W-2s get submitted through multiple sources, they do get added together as though they are standalone W-2s. But if I were to accidentally submit multiple times W-2s through the same source, they would only accept one of the filings, and all the rest of the filings would be rejected. So I'm not entirely, because I don't know what payroll software, I I know that when the W-2s get, I know that when W-2s get e-filed through QuickBooks Desktop, the process goes, they're submitted, they wait in a queue, and then as the IRS or when Social Security is really busy accepting, it can sometimes take a little bit longer. This year, it took weeks rather than days or instantaneously being received. And I think just the way this question is worded, I really think that they use QuickBooks Desktop. I would not submit them through another source as long as you've got them as long as you've got them submitted and they're waiting in the queue. The very rarely does it not ever process. I have had it happen a couple of times where it we later had to resubmit them, but as long as the W-2s get submitted, the the real penalty is with not getting W-2s to the employees on time. The penalty that you get from not having it submitted to Social Security or the IRS on time is a civil penalty, and it's based on the percentage of the tax. And it's normally not a penalty that gets issued until it's been years and other notices have gone unanswered. And then there's a question in the chat here. What does she mean run payroll manually from QBO? I know running manual payroll is through Excel sheets. They just say that they're running manual payroll through QuickBooks. I think QuickBooks Desktop does process manual payroll, and it processes after the fact. QuickBooks Desktop Payroll does a lot of things that no other payroll software has the capability of doing. So I think that's what they mean by saying that they're running manual payroll. My client is switching payroll providers next month. The new payroll provider stated they would get 2 W-2s issued next year, one from Justworks and one from ADP. This makes no sense to me, and I think is bad advice. I want to stop the question here because Justworks has a PEO, and PEOs operate a lot differently than having it, because the the W-2s are issued using the PEO federal tax ID number, and the W-2s and the federal returns are issued using the PEO tax ID number. But if they're leaving a PEO and going to a regular payroll, the employees will receive 2 different W-2s. Normally, yes, the payroll history would be brought over to the new software, and only one W-2 should be issued to the employees of the client. And I have just doing what I do, even if the everything is brought over 100% correctly and the former payroll software is canceled correctly, it happens way more often than it should, in my opinion, where both payroll softwares issue W-2s. And what generally ends up happening is the new payroll software does correctly bring in all of the historical payroll. So their W-2 lists 100% of all the wages paid to the employee during the year. And the old payroll software is just going to have a portion of it. But what happens all the time is, as long as the W-2s are sent to Social Security from different sources, they get added together. So then what happens is the W-2 wages are overstated, which then will trigger a series of notices. You'll get a wage mismatch notice, and when then the IRS will issue a notice saying that you've underpaid and underreported your wages for the year. They always add the additional wages to the last filed quarter of the year, and then they assess penalties and interest based off of that. And that is the first thing that we need to deal with, is getting the incorrect W-2s all zeroed out. And we do that directly on the Social Security Administration Business Services Online website. We did used to use a different software that was slightly easier to use and had less downtime. However, we had a lot of issues with corrected W-2s not being sent to Social Security Administration until some of them didn't get sent or processed for 10 and 11 months. So we quit using another software and file everything, whether it's a corrected W-2 or an original W-2. If we're not filing it directly through the software, we do everything directly on the Social Security BSO website. And I want to address the sentence: from what I have learned, the IRS only wants one W-2 per EIN per year, or it could cause all kinds of issues. That's not necessarily true. The IRS doesn't care how many W-2s they get that they add together. As long as the wages are not being overstated, that's where you end up with issues. And the CPA could be correct, could be not correct, that it's not a big deal if the employees have two W-2s next year. The biggest thing is that the W-2s match it. When you add all the W-2s together, does it or does it not match the total wages that were paid for the year? Oh, this one. I kind of like 1099 questions because they can be super interesting. So a client received two forms for commission paid to them in 2025. One was a 1099 NEC with box 1 for non-employee compensation and box 7 for state income filled out with the commission amount and the state of Virginia referenced. And further down, it does say that the client is Virginia based, so the 1099 NEC made sense. It's just missing the withholding amount. But what this firm did is they also issued a 1099 miscellaneous for the same commission amount and put the state income and the state withholding for the tax withheld with Pennsylvania referenced. The 1099 or the company was in Pennsylvania and the employee or the client is in Virginia. I'm not going to get into if the commission should have been paid as if this was an employee and the commission should have been paid as wages, because sometimes it is entirely possible that an employee receives commissions that are not directly paid by their employer. It's really common in the auto industry where the salespeople get what's called spiffs, which is a form of commission, but it's not paid by the dealership that employs them. It is paid by the car manufacturer that they have different incentive programs. So we're just going to assume that a 1099 NEC with state withholdings is the correct form that should be sent to them. But I don't think that what they received is correct because there is a box on the 1099 NEC where I've got a 1099 NEC on the left and a 1099 miscellaneous on the right. On the 1099 NEC, you've got a spot for the non-employee compensation, which is box 1, which she indicated was filled out. And then there is state tax withheld, which the poster indicated was put on the 1099 miscellaneous. And the state income tax or the state income was listed on both the 1099 NEC and the 1099 miscellaneous, but the state was listed differently. One of the forms listed the state as Virginia, and the other state or the other state listed on the 1099 miscellaneous was Pennsylvania. There should only be one state that the wages or that the commission would be subject to tax. And I'm assuming the issuing company was in Pennsylvania. And Pennsylvania is one of the states that requires all 1099s to be sent to Pennsylvania, where if the recipient is in Pennsylvania. And sometimes Pennsylvania companies get confused. They think that they need to send all of their 1099s to Pennsylvania, but it's my understanding that only if the recipient is in Pennsylvania do you need to submit to Pennsylvania. And most of the time, the state tax withheld is only going to be withheld for one state. So the question that I would have before I can really finish answering that question is, were taxes withheld for both Virginia and Pennsylvania? And if so, my answer doesn't change. The taxes should have been, or all of the commission should have been reported only on the 1099 NEC, not also on a 1099 miscellaneous, because that's going to duplicate, that very well could duplicate that person's earnings, and it could cause issues when they file their 1040. Let's see, we have a question in the comments here. What is the difference between preparing W-2s and 1099-R for government workers compared to business workers? Is there something that should be done different for government workers? And I don't know the answer to that question because I have only done one project for a government entity, and that was a municipality that did not have a 1099-R for their employees. So I really don't know the answer to that question. But if anybody watching the replay knows the answer to that question, I welcome it to be left in the comments. The follow-up question was, how did I do it? There was no 1099-R because the municipality was not eligible for their employees to receive a 1099-R. So everything was just handled straight on the W-2. Another follow-up question, they wanted to know what software I used for that. When we do payroll reconstruction here at Payroll Restoration, we use QuickBooks Desktop most of the time. The only time, and the rest of the time, we use Excel because the software is the options for reconstructing payroll, especially if it's a prior period or a prior year, is very, very, very limited. And we have the most flexibility with QuickBooks Desktop. Most of the commercially available software that people use cannot even could not even recreate a payroll for yesterday if that is prior to the start of the contract with that software. So we use QuickBooks Desktop Payroll, and we use Excel for all of our payroll reconstruction work. What if they don't have desktop? I guess I don't understand the question, because if the government has their own software to process the payroll and do the W-2s and the 1099-R reporting, I would think that they wouldn't need QuickBooks Desktop. QuickBooks Desktop Payroll is just what we use when we're reconstructing payroll for prior years and prior periods, so that we can put either, like if it's in the current year, what we reconstruct would go into their payroll software. But as long as somebody is using a payroll software that works for them, they don't have to change their payroll software. But sometimes, and because I don't know about government worker payroll, because the closest I've come to government workers was a municipality, like it was a sewer and waste treatment facility. So they're government employees, but they're not government employees. They're treated a lot differently than a regular government employee. And I don't have any experience doing government employee payroll. So I don't know if I can really answer that question. So I'm going to throw the previous invitation out to the audience watching this recording, is to, in the comments, if you have any thoughts or suggestions or anything, please definitely leave a comment. All right. So the next question is, my client needs to retroactively enter qualified overtime tracking for the first 6 weeks of the year in QBO. Is there a clean way to do this? I've looked into it so much and I can't find any straight answers. Should they just add it to their next pay run, adjusting the qualified overtime box? Running a zero payroll to encompass the year-to-date totals doesn't seem to be working right, and adjusting prior payroll runs seems messy. That is a tough question to answer, because I don't know that any payroll software really, every payroll software that I'm aware of really brought in the whole qualified overtime tracking in. It really seems like at the last minute, and some software, it wasn't available for the first payroll runs of 2026. So I'm anticipating that at the end of 2026, when we are reviewing W-2s, there's a lot of people that are going to need manual overrides on their qualified overtime tracking. Because I think the official information, at least right now, that's put out by Intuit for QBO payroll is to fill in that payroll adjustment sheet and let that work its way through the process. My thought on that is that we do, as soon as we can view the 2026 W-2s, we take a look at it. And unfortunately, I am really anticipating a lot of W-2Cs for 2026, not just for the qualified overtime tracking, but to also reclassify tips, because a lot of what gets put in as a tip is a gratuity, and tips and gratuities have always needed to be kept tracked separately, but there was no issue if they weren't. But now with the OB3 no tax on tips, it is very, very important that gratuities don't get mixed up with regular tips. Oh, this kind of ties into the end of my last answer. Client is asking about tips or gratuities as they find some articles regarding a lawsuit by employees for pooling tips. In the discussion with the client and their payroll service, they have been combining tips and gratuities all along, which they're technically not supposed to, but is if the business isn't applying for the tip credit, then it was less of a big deal than it's getting to be now. All of the tips in and out are processed on the payroll sync, go to the balance sheet. So since the beginning of the year, they have done this and want to know if they should go back and fix it. I know from researching the new W-2 that these two payouts have different treatment, both for the recipient and the financial reporting. Should they go back and fix it from the beginning of the year? I mean, the short answer is yes, it should be reported correctly. But the next question kind of throws a wrench in that. What responsibility do I have for not knowing? They let the bookkeeper go and the COO took over their duties. They don't track gratuity revenue on the P&L. Maybe this is more about frustration over a client who may believe it's not important to let me know. Yes, gratuity revenue, like anytime you go out to eat and there's a gratuity or an automatic tip added to your receipt that you are compelled to pay as part of the purchase, that's a gratuity, and that is revenue to the business that puts the gratuity on the receipt. Then there would be a gratuity expense for when that is paid out to the employees, because gratuities don't have to be paid out to the employees. They have a completely different set of rules governing them. But if you go out to eat and you either add a tip to the credit card or you put cash on the table, that is a tip. It is meant to be paid directly to the server that you had or the server team, because sometimes you'll have like the person that takes your order, then you'll have the person that delivers your food, and it could be a different person that fills up your water or whatever. That just it's a team to make that restaurant experience an enjoyable one instead of it just all being on one person. And when a tip is considered a free will offering for exceptional service, and a gratuity is something that you're forced to pay. They do need to be tracked separately for bookkeeping and for payroll. If gratuities get paid out to the employees, it's wages. When tips get paid out to employees, it's a tip. And there is on the 941, there is a separate spot for tips. And on the W-2, there is a separate spot to report tips. And it's really important in, it was important in 25, but we didn't know it was important in 25 until after the 4th of July. And the rulings kept coming in. I think the latest ruling on this was just a couple weeks ago at the beginning of February 2026. And so there's not the IRS has basically come out and said that they're really not going to penalize people for using their best guess for qualified overtime that's not listed on the W-2 or for tips that are not specifically listed on the W-2, as long as you have proof that you have a tip and it's not a gratuity or a payment for service. So, but for 2026, there is no grace period. It has to be correctly reported on the W-2. So now there's a lot of us that are bookkeepers that are backtracking and trying to fix the books or fix the payroll. And like I said on the last question, I think there's going to be a lot of corrected W-2s because we've got almost 2 months now where it's possible that things were not correctly reported, but there was definitely 6 weeks where some of the rules and some of the software didn't have the capability of putting things correctly into the flow so that they're going to go on to the right parts of the 941 and the W-2. So I think there's going to be it is very possible that there's going to be a disproportionate amount of corrected W-2s that get issued at the beginning of 2027 or throughout 2027, just because things were not properly captured, either due to limited knowledge or the software capability limitation. Because at our firm, we use a couple of different payroll softwares for different things. And a lot of our clients did not get the pop-up to set up their qualified overtime until the second or third payroll that we did. And even though we were running the software updates, it just didn't happen. So with QuickBooks Desktop, we can go back and change the historical payroll. But if you're using a software like QuickBooks Online, Gusto, ADP, Paychex, or any of the other payroll softwares that are available out there, you don't have the ability to go back and change historical payroll. You just have to try and fix it. And if support doesn't know how to do it, I don't know that you'll probably find some bookkeepers or payroll people that use that software that'll have a workaround. But my workaround is to go in and overwrite what's on the W-2, which is not always possible on a lot of different software. So sometimes what the easiest thing to do is to let the incorrect W-2 go out, but then immediately go onto a service and do a corrected W-2. And the employee will need to when an employee gets a corrected W-2, they need to take the original W-2 and the corrected W-2. Both of them need to go to the tax preparer to get their taxes done, because a corrected W-2 is only going to report things that changed, not things that stayed the same. I want to thank everyone for attending this quarterly Q&A for the Payroll Restoration Community for accounting and business professionals, and keep the invite open so that you come back the next time we do one of these calls. All right. Thank you, everyone.